Are you here to improve your investment strategies? Are you looking for that one article that could help you finalize that decision you were holding off? Well then, get ready to learn more and gain just that subtle extra knowledge to get an edge in the investment business. Because if you're new here, then you've come to the right place. Welcome to The Daily Fortune, a channel where we talk about all the latest news, updates, guides, and strategies related to investment. Of course, with that said, we're going to be discussing a lot about the Oracle of Omaha, Warren Buffett, The Big Short, Michael Burry, the money tree Cathie Woods, Tesla's very own CEO and eccentric billionaire Elon Musk, along with the rest of the big leagues to learn just a bit more from the professionals. And don't worry, of course we talk about crypto, and we also talk about the best stocks to invest in, along with many tips and tricks on how to handle your finances so you never lose. So before we talk about making money, remember to hit that like button, subscribe, and ring that notification bell as well to make sure you won't miss a single video. Now let's get started. Peter Lynch managed the Magellan Fund at Fidelity Investments for 13 years, turning $18 million into $14 billion at a 29.2% average annual return. There are a lot of people who think of Peter Lynch as the stock market genius, but the more you delve into his life, the more you find that his success came from a mastery of the long-term investment temperament. And it's this investment temperament that essentially determines whether you win or fail when it comes to investing during a high time of volatility like a market crash. In this video, we'll talk about some of the clips of Peter Lynch's presentation from 1994 so you can hear the strategies he applied to profit from significant market crashes. Unfortunately, when the market crashes, most investors often do quite terrible things. There are shocking news stories, fear is pervasive, and people frequently make really unwise choices. In order to profit from a stock market crash, one must first realize that a crash would actually happen, as Peter Lynch stated. You are aware of its inevitability. Nobody can anticipate when your portfolio will be affected, but it will happen eventually. Peter also said that people get carried away too easily, and trying to predict the stock market is definitely a complete waste of time. The stock market is extremely difficult to predict. Don't believe that you'll be able to predict the crash, but know that it will happen and that it will surprise you at some time in your investing journey. Therefore, if you plan to own common stock, the first step in profiting from a crash is to accept the fact that you will suffer one and no one can foresee it. And once you're comfortable with that thought, you can begin to see how you may make money from this unavoidable event.
And the key organ in your body in the stock market is your stomach. It's not the brain. If you can add 8 and 8 and get reasonably close to 16, that's the only level of math you need to know. All you have to know is you're going to see it's always going to be scary. There's going to be always something to worry about. And you just have to forget all about it. Cut it all out and own good companies or own turnarounds. Study them and you'll do well. And that's all there is, and I'm ready for questions.
Therefore, you really don't need to be a genius to profit from a market crash. It's all about your stomach. In spite of the fact that it's truly pouring gold, most individuals lose money when the market crashes because investing requires a very difficult temperament. At this phase, we realize that these crashes will occur, that we won't be able to predict them, and that the anxiety and panic often induces us to make poor decisions that result in permanent capital loss. Let's focus now on some of the steps we must take in order to benefit from a market crash. And as Peter Lynch would put it, you need to know what you own, and this is the first step.
I made money in Dunkin' Donuts. I can understand it. When there was recessions, I didn't have to worry about what was happening. I could go there and people were still there. I didn't have to worry about low-priced Korean imports. I mean, I just didn't have, I can understand it. And you laugh, I made 10 or 15 times my money in Dunkin' Donuts. Those are the kind of stocks I can understand. You shouldn't be calling your broker 4 times a day to get stock quotes. It doesn't work. Getting up in the morning to look to see how your stock did yesterday is not useful. You should be looking at the company when you get the quarterly reports. You should be, if you're at the mall, imagine if you were in the retailing industry or if you're in the restaurant industry, you would have seen Taco Bell, you would have seen McDonald's, you would have seen Toys R Us. I mean, you would have seen all these companies do terrifically well. You would have seen Bombay, you would have seen Tandy with Radio Shack, and you would have seen Radio Shack roll across the country, and pretty soon there were 25 Radio Shacks in every major city, and you said, there's not much room for them to go. But they had a 20-year great run. That's what you're dealing with. You're not dealing with the minutia of today. You're dealing, what's this company doing 2 years, 3 years, 4 years, 5 years from now?
Thus, Peter Lynch focuses on two important ideas that will help you get through any market crash. The first one is knowing and understanding what you have in your portfolio. When the stock is falling, your fear and anxiety will be greatly reduced if you truly understand what you've purchased, because you'll know you're holding good company. You're aware that the company is reliable, has no debt, has tremendous profit margins, or has a significant competitive advantage. You did some calculations and did something about it, and you'd purchased it substantially below its intrinsic value. Knowing that you're actually purchasing $1 for 50 cents when the stock drops, you might actually start to become excited. However, if you hadn't done the research, you won't know where the company will be in a year when the price drops for some reason. Basically, when you check your stocks in a company, you'll always be able to make wise selections when the sky is falling. Secondly, Lynch also mentioned keeping a long-term perspective for investing. You will undoubtedly lose money if the stock market crashes, and you were hoping to make, say, $10 this month to help with your rent payments. However, if your objective is to, say, succeed in 10 years, stock market crashes will suddenly seem like nothing to be afraid of. When the stock market goes down, you find the proper companies and buy them up. Then all you have to do is wait. Over the course of the following year, 2 years, or 3 years, the market will correct itself and you will profit. Even in the GFC, it only took 5.5 years to return to your position at the previous peak. And if you hung in there for 10 years, you would have earned a bunch of money.
So don't get, you have to understand it and say they're doing well, and as long as they keep doing well, my best stocks have been my 5th, 6th, 7th year I own them, not my 5th, 6th, 7th day. So you have to understand that and stay with it. You only need to buy a few stocks every decade. When your lifetime's over, you don't need a lot of 5-baggers to make a lot of money starting with $10,000 or $5,000. You could have bought Walmart 10 years after they went public and made 35 times your money. If you bought it when they went public, you would have made 500 times your money, but you could have waited 10 years after Walmart went public and made over 30 times your money. You could have waited 3 years after Microsoft went public and made 10 times your money.
Decide on the best firms to invest in and stick with them. If the market does crash, you can run up your valuation and discover that you have a fantastic long-term opportunity to purchase the company for a very low price. We aim to purchase $1 bills for 50 cents each, as Buffett said. Peter also discusses in that video clip how you just need a handful of truly great stocks in your lifetime. The amazing thing about a market crash is that these irregular purchasing opportunities actually start sprouting up everywhere. Typically, it's quite difficult to discover these kinds of opportunities. You are aware that during significant market crashes like the GFC, almost every stock on your list will become so cheap as to represent excellent prospects for multi-bagger gains. In the midst of a severe market crash, the knowledge that you only need a few large stocks in your lifetime and that these opportunities typically arise would hopefully change your perspective. Change your fear into opportunity. This is a once-in-a-lifetime opportunity, so go and grab it. Take the risks. Finally, I just wanted to show one more Peter clip about a quality that a business should have, especially in a market crash.
Because a lot of times people buy on the basis the stock has gone down this much. How much further can it go down? I did the same thing in my, I think my first or second year of Fidelity. Kaiser Industries had gone from $26 a share to $16. I said, how much lower can it go? It's 16. So I think we bought one of the biggest blocks ever on the American Stock Exchange of Kaiser Industries at 14. I said, it's gone from 26 to 16. How much lower can it go? Well, at 10, I called my mother and said, Mom, you got to look at this Kaiser Industries. How much lower can it go? It's gone from 26 to 10. Well, it went to 6, it went to 5, it went to 4, it went to 3. And at 3, I figured out, there's something very wrong here because Kaiser Industries owns 40% of Kaiser Steel. They own 40% of Kaiser Aluminum. They own 32% of Kaiser Cement. They own Kaiser Broadcasting. They own Kaiser Sand and Gravel, Kaiser Engineers. They own Jeep. They own business after business, and they had no debt. Now, I learned this very early. This might be a breakthrough for some people. It's very hard to go bankrupt if you don't have any debt. It's tricky. Some people can approach that. It's a real achievement. But they had no debt, and the whole company at 3 was selling at about $75 million. At that point, it was equal to buying one Boeing 747. I said, there's something wrong with this company selling for $75 million. I was a little premature at 16, but I said, everything's fine, and eventually this will work out. And what they did is they gave away all their shares to their shareholders. They passed out shares in Kaiser Cement, they passed out shares in Kaiser Aluminum, they passed out the public shares in Kaiser Steel, they sold all the other businesses, and you get about $50 a share. But if you didn't understand the company, if you're just buying on the fact the stock had gone from 26 to 16, and then it got to 10, what would you do when it went to 9? What would you do when it went to 8? What would you do when it went to 7? This is the problem that people have. is they sell stocks because they didn't know why they bought it, then it went down, and they don't know what to do now. Do you flip a coin? Do you walk around the block? What do you do?
Peter Lynch is definitely right that most people lack the necessary knowledge of the company to know what to do when the stock drops. However, what made his story about Kaiser Industries remarkable was the fact that he knew the company was successful because it was debt-free. It's difficult for a business to fail if the cash flows continue to be sufficient to meet the costs and there is no debt. Another suggestion for managing debt levels in tough economic times and market crashes is to take the example of Facebook, which has no debt, and Google, which has a debt of probably $14 billion, but has cash and short-term marketable securities worth $142 billion. They just aren't going bankrupt, and if they aren't, nothing can force them to do so. In that case, it will only be a matter of time before the market crash occurs, and then things resume as they were. Therefore, if your company has no debt, you've added a measure of security about the future of the company, which is comforting in the midst of a recession. And there you have it, Peter Lynch's advice on how to not only survive, but also thrive during market crashes. Hopefully that's given you some insight into some of the strategies and the secrets on how you might actually end up making a large profit from stock market crashes. They might be pretty frightening if you haven't experienced a major one before, especially for beginners in the investing world. But when you take the time to comprehend this long-term investing temperament, they actually show the best opportunities you'll ever have in the stock market. Stock market crashes will be your friend over the long term. You can share your thoughts in the comment section below, and thank you for watching. So that's it for today. I hope you learned something from today's video, and to get updated with the next videos, don't forget to hit the notification bell. See you next time.